Thanks for checking out our YouTube channel, Bookkeeping Concepts Made Simple, in which we take individual bookkeeping concepts and seek to understand them, because I strongly believe that understanding is a faster way to competence than memorization. Today I want to talk about accounts. Accounts are pretty fundamental to bookkeeping. An account is a method of grouping bookkeeping transactions according to certain characteristics. And there are only 5 types of accounts, and you've probably heard of all of them. The 5 types are assets, liabilities, equity, income, and expense. That's it. Every leg of every bookkeeping transaction falls into one or more of those 5 account types. So what are they? An asset. An asset is something that you or your business owns from which you expect to derive a future benefit, okay? Assets are things like trucks, equipment, inventory, also things like accounts receivable or money owed to you. So assets can be tangible, like the trucks and equipment, or intangible, like accounts receivable or a debt instrument, somebody owes you money. So assets are things that you own. Liability are things that you or your company owe to outsiders, to non-owners. Liabilities are things like accounts payable that you owe your suppliers, that payroll tax deposit that you owe to the IRS, the loan that you have on your trucks or your real estate that you owe to the bank. Those are all liabilities. And interestingly, liabilities are all intangible. There are no tangible liabilities. Now, you may be able to feel liabilities, as when you lose sleep worrying about them, but you can't touch liabilities. So you have assets are what you own, liabilities are what you owe to outsiders, to non-owners. Equity is what the business owes to the owners. Equity comes last, both on the financial statements and in reality, because outsiders always get paid first. So if you were to liquidate, to sell all of your assets, you must first pay all of your outside debt holders, all of your liabilities. What's left over is yours. That's equity. So you have assets, liabilities, and equity. The last 2 account types are income and expense. Income is money that comes into the business, not through borrowing, not through contribution of the owner, but from sales. Only sales. Income is sales. Expense is money that you spend in an effort to get sales. Okay? So expenses are things like the gas bill, the utility bill, things like that. I think we all have a pretty good concept of expense, except that when I look at books, I frequently see people put their car payment in there. Well, there are some subtleties to what's an expense, but it's pretty much forthright. This is a good time to bring up another important concept, and that is cost. We often hear the word cost thrown around, and it's an important concept, and it's worth understanding where it comes from or what it means. A cost is an outlay of funds, or the promise to pay funds later, made in anticipation of a future benefit. As I said earlier, a future benefit in business means generally an increase in sales and an opportunity to make a profit. So a cost is an outlay of funds or a promise to pay funds later in the effort to get sales and profit. But we can expend a cost buying an asset, or we can expend a cost on an expense. So what's the difference? About buying an asset and paying for an expense are both costs. Well, here's the difference. It's a little bit subtle, but it's an important distinction. If you were driving your truck to make a call on your customer, the gas that you burned driving to see the customer would be an expense. The truck is an asset. What's the distinction? The distinction is that the gallon of gas was entirely used up. The anticipated benefit was entirely used up in an accounting period, typically a month or a quarter or a year. But if the benefit of the cost is entirely used up in the accounting period, it's an expense. If the benefit, anticipated benefit, extends beyond the current accounting period, the cost is an asset. So I buy a truck and it's worth something today, it's worth something tomorrow, it's worth something next year. It's an asset. I burn a gallon of gas today, it's used up, it's an expense. So there are your account types plus 1 bonus tossed in. Assets, liabilities, equity, income, expense, and the concept of cost. If you like these discussions, please subscribe to my channel. And if you're in a hurry and like to get ahead, check out my book, The Profit Problem. They say I make money, so why don't I have any? In that book, we discuss these concepts, but I go further to answer questions and show you as a bookkeeper how you can help your business clients use financial information to make better decisions and more money.